answering your tough financial questions for the past 26 years. It's Allworth's Money Matters with co-hosts Scott Hanson and Pat McClain. Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hanson and Pat McClain would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH.
Welcome to Allworth's Money Matters. Scott Hanson.
Pat McClain.
Glad you are here being part of our program today. Both myself and my co-host here, we're both practicing financial advisors and 3 decades of doing this. And we've been doing this radio program, podcast for 25 years. Not the podcast, because the podcast didn't exist 25 years ago, but
we have been doing some sort of call-in talk show.
And one of our main objectives on doing this program is to help you have more confidence with your finances, make wiser choices with your investments, and have overall be in a good place financially, where financials is not causing you a lot of stress in your life, and you've got...
It's hard not to have some stress in your life right now with financials, regardless of whether you're employed or continuing to save, or just everything around the environment kind of pushes a little bit of stress.
It's just a weird... I mean, this is hard. We're all dealing with this in different ways, right?
Oh, yes.
And some people's fears are different than others. And some people, I read an article a couple weeks back, and the writer of this article had stated that whenever she talks to someone, she looks the other way, and in order for her to do that, she won't look them in the eyes. She looks the other direction to ensure that she won't be breathing towards them.
Oh,
and she said she believed it was the loving thing to do. And I appreciate her thoughts on that. But I just remember, like, if I have to go through my life without anyone looking me in the eyes, I don't. I mean, I'm a very social person. I just was like, so it's just there's all these other stressors at the same time. And family member, maybe you're out of work, or your family member's out of work, or your kids are home,
or you've got kids that have graduated from high school that didn't get to.
Are you trying to figure out, do I pay that tuition bill?
Yeah. Yeah.
Or do I have my kid go to junior college because it's going to be online?
Yeah. So it's hard. It's stressful. We like to talk about try to control the things you can control. If you can control it, right, then try to control it, including your own.
And if you can't, then don't worry about it.
Then don't worry about it.
I mean, of course, that's a good way to go through life in general, right?
Right.
All those things, yeah.
Well, my grandfather used to call it borrowing trouble. He said, don't ever borrow trouble. I'm like, what's that mean? He said, if you can't affect the outcome, if it's by random chance, you have no way of affecting the outcome, then don't worry about it. And so when we think about our investment portfolios, it's how we react to them. If we think about our savings, it's how we react to them. The reality is, if you're stressed out about retirement, 62% in the survey done just this month, 62% of people said they were more concerned about retirement today than they were a year ago. And that's up significantly.
Well, yes,
people are just
no one expecting this.
Yeah, this too shall pass, though. There will be a therapeutic.
I know it really does.
There will be a vaccine at some point in time. The question is when.
Yeah. Well, yeah. And investors right now are clearly looking much more long term. Anyway, let's take some calls here because we've got quite a few lined up. 833-99-WORTH is the number to be part of the program, 833-99-WORTH. Let's go to Sacramento and talk with Vince. Vince, you're with Allworth's Money Matters.
Yeah. How you guys doing today?
Good. How you doing, Vince?
Vince, any better? If I was doing any better, I'd be twins.
Yeah. So, guess I ask my question now?
Sure. Ask your question.
Yeah.
I've heard you say that 100 times, Pat. I don't really know what that means. And Vince didn't either. So.
What it means is that there's just so much good going on. It'd take 2 bodies to contain it all.
Okay,
that's how well I'm doing.
Okay,
it just
great.
means that it's so awesome.
It's unbelievable. Okay,
all right,
Vince.
there we go. But
your question,
back
please.
to you, Vince. You had a question.
All right. Yeah, I was wondering because I was talking with a friend and we were discussing, and she's retiring in a couple months, and I'm looking at retiring in about 3 years. And so we were discussing our 401k, rolling it over to traditional IRA. And her concern is during this downturn of the market that whether she should wait until it goes back up before she rolls it over to her traditional IRA. And I was kind of saying, well, if you're going into similar funds from rolling over, it wouldn't matter. And it just became kind of a discussion, and we kind of and just kind of get some thoughts on.
You are right. She is wrong.
That's right. Right?
Let me caveat. Here's the one caveat. Oftentimes, companies will send physical checks. They won't do a wire transfer. And so, and even in a wire transfer, there could be a couple days where the money's not invested.
But that could be a negative or a positive.
Mm-hmm.
That's right. I mean,
right?
That's the only.
Yeah. But it's
or the other thing, and this doesn't have anything to do with the markets, if she's under 59 and a half, but over age 55, leaving it in a 401k provides access to those dollars without any restrictions or without any early withdrawal penalties. If it goes to an IRA, then there's restrictions and withdrawal penalties.
Until the age of 59 and a half. How old is your friend?
The friend is 57.
All right, so she may want to leave, and it has nothing to do with the argument that you guys were, or the discussion you were having. It has more to do with liquidity. So the rules are if you're 55 and older in the year in which you separate from service, the 401k can be accessed without penalty, and the penalty in the state of California
is 10%.
And are you from?
Oh, yeah.
Where are you calling from?
Yeah, Sacramento.
Sacramento. So it's 10% federal and 2.5% in state. So she
Okay.
may want to keep all or some of her at the 401k, but it's not an either or. She can roll part of it to an IRA and leave part of it liquid in the 401k. But that is probably the bigger driver, is that she's under the age of 59 and a half and older than 55, why she should leave some money in her 401k. All things considered.
Yeah, because you give it, we were talking about, because you give us more options to invest in too, as opposed to limited to your 401k options.
Understand. That's the IRA. That's the reason you want to roll it over. But the reason she may not want to roll it over is the minute she rolls it over into an IRA, if she wanted to go in there next year and take out $10,000 just willy-nilly, there would be a 10% federal and 2.5% state. Where if she left it in her state penalty, where if she left it in the 401k, those penalties would not apply.
Even if it's a traditional IRA?
Yes, correct. Correct. Any IRA.
Huh. I did not know that.
No, most people don't. I don't know how you would know. I don't know how you would know that.
Well, thank you very much.
I mean,
yeah,
it's pretty esoteric. It's pretty
yes,
esoteric.
and oftentimes, to be real blunt, oftentimes financial firms don't mention that because they have a financial interest to get that 401k rolled into their IRA. So when someone's 56 or 57 or 58, they just say, oh, let's get it to your IRA. But the fact is, if someone leaves an employer and they will be 55 or older in that calendar year, so they could be 54 even, but if they'll be 55 in that calendar year, they have access to their company's retirement plan without any restrictions, without any early withdrawal penalties. I mean, I say with restrictions, the company could impose like a finite amount of withdrawals. So if somebody, unless somebody's fully certain they don't need the money until 59 and a half, it makes sense oftentimes to leave some dollars in that 401k plan. That's one argument for leaving it there. Secondly, it depends. You sound like you're on top of things and pay attention to the markets, but not everybody does. And so at least in the 401k, there's some sort of pre-screening and there's some sort of momentum in the way it's investing. And oftentimes if people don't have the proper guidance from a professional, a qualified professional, and do things on their own, they could make poorer investment choices than they had in their 401k. So there are arguments both ways. And so I think we started by saying you're right and she's wrong. You're both right and you're both wrong. So anyway, appreciate the call, Vince, and hope that was helpful. Let's continue on with calls. We're in Rockland talking with Scott. Scott, you're with Allworth Money Matters.
Hello, how you doing?
Great.
Thank you very much for taking my call. I love your show. I've been listening forever, and appreciate you getting me in. Wish you guys were still doing 2 hours, but I understand for personal reasons it's probably nicer doing one.
We haven't done 2-hour radio program in several years. We had what? We had a year where we did 3 hours, and
which is like an hour past.
I don't know how guys or gals do a radio show some do it every day for 3 hours. I don't know how they do it. But.
Yeah, so that's like 2 hours past my attention span. But what can we do for you?
Well, I enjoy you guys. I listen to you on podcasts when I don't get you on Saturdays.
Review us, please.
I will. I'll make sure I get on and do the 5-star review. What'd you say the other week? You had 3 or 4 reviews total. I'll bump you up by 20%, maybe.
Yeah. We're actually not allowed because of our industry. We cannot ask for positive reviews.
We can't. Yeah, we can't say like us on Facebook.
Yeah.
We could say connect with or something. We can't say like us.
But
isn't that funny?
But so if you go on there and do a review,
or give us a bad just give us an honest review.
You don't want a bad review, Scott. Why would you say that?
He just said he loved us. He's not going to give us a bad review.
But he's more than him or listening to this show.
Oh, please don't give us a bad review.
Thank you. All right, what can we do for you, Scott?
Please, actually, no.
Well, actually, here, let me say it. Anybody listening, please don't give them a bad review. They're awesome.
Thank you.
There.
Thank you. Now that we got the marketing out of the way, what can we do for you?
So I'm, as some of your other callers have said in the past, a sandwich generation. I have older parents and having issues. I've got kids. I'm 2 years away from having 2 kids in college. My sister has 2 kids in college, and my parents, who used to have a comfortable upper middle class life, are now living on Social Security alone.
Wow.
They're living on about $3,300 a month. Luckily, they own their home, but they live in a home that has property taxes, obviously, and also has a HOAs involved. So their cost of living there is about $800 a month. The value of the homes, probably $325, $330.
How old are they?
And he's turning 78 or 77 this year. 78 this year. And my mom's going to be 76 this year.
All right.
They've lost most of their assets in 2007 and due to some other issues. And so the things they have left is life insurance. And my mom's been servicing their life insurance policy. Unfortunately, she was allowing my dad, who had dementia, take care of them. And one of them ended up lapsing for lack of payment because he forgot to pay it. And his health has turned.
Did they send usually there's some sort of reinstatement period on these.
Yeah, and
it was beyond that. We tried.
Okay.
And there was no cash value in it whatsoever.
Don't know. It's identical to the policy I'm calling about now.
Okay.
They have 2 of them.
All right.
So, and it was just like a year and a half ago, 2 years ago, this happened. We went back and forth with them. They wanted medical records and all this stuff that would have been just insurmountable to try and get on my father.
Got it.
California doesn't provide for a reinstatement due to medical.
What's the
question on the existing life insurance policy?
Okay, so he's had this policy since April of '85. It is they call it a what kind of policy? I'm sorry, I just had it. It's by Voya companies.
Universal Life or Whole Life? Probably Universal Life.
It's called. They've got a. I just had it. Sorry.
How much is the death benefit on it?
It's $100,000. It's a Designer Life Plus, is what they're calling it.
And is there? Ooh, Designer. I like that.
Yeah, exactly.
Is there any cash value in it?
There's a loan for $14,400, so the payoff is $85,000. They sent her a letter apparently in 2016 saying that the cost of insurance was going up and that she needed to pay more, and she didn't. She continued to pay the amount she was used to paying.
Yep.
There is currently an accumulated value in it of about $15,000. Let me get to that page. Beginning accumulated value, and $14,963 is the ending accumulated value. But then there's also the loan for $14,480.
Let me just get some. Let me get some
and the
clarity
net
here.
cash.
Go ahead.
Go ahead.
Is your major question here today is how are we going to help our parents? We're getting deep in the
So
weeds.
they've sent her a bill for the arrearages on the payments of about almost $1,400.
You don't really have to pay that.
Yeah.
And the interest of $676. So we've got to come up with a little over $2,000 to keep it current. And,
So you've got I'm thinking you've got a couple options in front of you. All right, here's with this life insurance. You could do a couple different things. One is you can keep this thing going until the day your father passes away. Okay, it'll be $100,000 there, and then it's like, let's figure out how we're going to do this. Two, you can sell this policy. Someone would buy it from you. It would be.
It would actually, you would actually get some.
Oh yeah, you get some cash.
You
for
get
it.
some cash for this, and what happens is the person that buys the policy then becomes the beneficiary and the owner of the policy, and they're responsible for paying off the loan and making the premium
Yes.
payments to keep it in force. They get their return when your father passes away. But
this is the viaticals I've heard you talk about in the past.
Yeah.
Well, we say don't invest in these life settlement companies or viatical companies. That doesn't mean there
isn't a market
to
to
and
sell
if you got
into.
and if you got a good policy to find someone to buy it from you. So that's
But tell us about yourself. Can you afford to make the premium payments on this?
So my sister and I have gone through her bills, and we've actually lowered some bills that she's paying and made it possible for her to be able to make up the difference.
When you say her, you mean your sister or your mother?
My mother, she's got enough. She's got enough to make it.
Is your dad
They're
ill?
living-
He's got dementia.
He's got dementia, and he's barely ambulatory.
Okay.
And
so don't sell the policy.
Don't sell the
Do everything
policy.
you can to keep the policy in force.
Do not let this thing lapse.
yes.
And you can ask the company to do an what do they call it? In-force ledger.
I could call it midstream, but there's a different name for it.
They did just recalculate it out, and they said that $5.15 a month will make it current and cover everything, I guess, or something like that.
Got
I
it.
haven't
Keep
seen
it
that
alive.
document yet.
But you might be able to pay less and still keep the policy alive.
I know.
You might want to just
Yes.
figure out what's the absolute bare minimum that we can pay to keep this policy in force.
Yeah.
Well, at the very least, I think we're going to have to pay the $2,000 is what I'm getting.
Okay, so that they can walk you through that. The point being is, even if you had to lower your contributions to your company 401k or your sister did, do not let this thing lapse.
No.
Right?
Okay.
Don't let this thing lapse at all.
Okay.
Yeah,
and that we've been looking at this all along as my mom's retirement
Yep.
for,
Yeah.
because my dad's been in poor health for a long time, and this was always kind of like, when he leaves, this is how he's going to take care of her. And they already lost the one that was identical to this.
And have you considered a reverse mortgage on this home?
So thank you, Scott. That's where I was going to go with it next.
It's been mentioned. It's been discussed. We're trying to hold off on doing any of that because there's no long-term care. There's no other assets in place, and so we're trying to hold on to the one remaining asset she has and preserve it as long as possible because we don't know what's going to happen with him. We don't know if he's going to have an issue where
if you and your sister can help out with some of the cash flow needs over the next year or two, I would probably do that. If it would be a financial burden for you or your sister I might do a reverse mortgage now.
Okay.
Yep.
Well, yeah.
And it doesn't mean you're giving up. Just think of it like a loan on the house. Think of it like a home equity loan. And you get instructions so you have a line of credit to draw against, so you don't have to pull it all out. And that you just don't, instead of making the interest payments, the interest just accrues on itself. So over time, the loan gets larger, but presumably the value of the home will get larger over time. So whatever equity is there, it's still your mom's equity, and she eventually passes away. If there's still equity there, it goes to the kids. So it can really.
And there's just you and your sister, correct?
Correct.
Okay.
And our spouses, which we have to negotiate with as well.
Them.
Yeah, I get that.
Those people. I understand.
Yeah.
Listen, I understand. I come from a family of 5 children, and we took care of my
between siblings and then spouses of trying to just figure out who's going to. It's not easy.
Yeah. So
so a reverse mortgage
fixes that.
It would fix that.
Well, as a student of the Hanson McLean School of Finance, I generally accept that as a reasonable last ditch kind of
Thank
effort.
you.
But
Thank you. Good enough. Good enough.
My sister and my spouse may be on different pages with that, so I'll have to work that.
Well, that's why.
Yep. So.
Yeah. And it's by the way, Scott, it's all worth is now the new
no longer
brand for
Hanson
Hanson.
But anyway, good luck to you. Thanks for the call, Scott.
Do everything you can to keep that policy in force 100%, and talk to the insurance company and figure out what is the minimum that we can pay. Even if it's going to go up year by year, you're fine with that. You don't need to have it level to the time he's scheduled to pass on mortality wise. What's the very minimum to keep the thing in force for the next year? And let's head to Denver. We're talking with Charles. Charles, you're with Allworth Money Matters.
Hi. So I have about $3,000 a month that I can invest or set away. I don't have a house. I got a divorce. I live with my mom still. And so I have all these options, Roth IRA, 401k, or put money for down payment on a house.
All right, hey, Charles?
Yes.
Two things. One, how old are you?
I'm 53.
And how much more money is there? In addition to this $3,000 you can save a month, do you have money in a 401k or IRA?
Yeah, currently I have $150,000 in the 401k.
Okay.
And I have about $10,000 in a Roth IRA.
Okay. All right.
And do you have children you're supporting?
No, I don't.
Okay. And you called to ask for our advice, correct?
Yeah,
Okay.
I have a para-retirement. I'm not retired, but I have about 34 years of Colorado State.
So you got a pension.
Retirement.
So here's my first bit of advice. You said that you live with your mother.
Yes.
In the future, I'd like you to say that your mother lives with you.
Okay.
It just sounds so much better. If you ever expect to get married again, that's how I'd approach it.
No, I don't think so.
Well, I gave you my advice. All right, so you've got 34 years with presumably you're going to have a pension from this job, correct?
Yes.
And the living situation like this, will it probably continue for some time? And might you inherit the home in the future?
I don't think I want to inherit the home, but part of the home, I have 4 siblings.
Okay, 4 siblings.
Yeah.
So, and how much cash do you have on hand? Like just plain, like have you
About
not
30,000.
Cash.
Well, not like
I have $72
like in the bank,
in my pocket.
that sort of thing. I don't know, Scott. What do you think? I think that you should try to build the cash reserves.
Well, I think getting a house at some point in time, the challenge when you here's the challenge, right? Your pay, if you look at your pay today and compare it to 10 years ago or 20 years ago, it's much higher, right, than 20 years ago.
Yes.
Right. And rent, right now you're not paying rent, but rent is much higher today than it was 20 years ago. When you retire, that pension is not going to keep growing over the next 10 to 20 years. It's going to remain the same level.
Well, and even if it has an inflation accelerator, oftentimes the inflation accelerators aren't the same as the real rate of inflation or the cost of housing. So the biggest safeguard you can get for retirement in inflation is the purchase of a home. And you're 53, and do you plan on staying in the same area when you retire?
Yeah, I think so. I'd like to stay in Denver.
I would like you to buy a house.
Yeah, I think I would agree with
Either
that.
now or in the next couple of years, and I would set this up so that the house was paid off at around the same time you retired. So,
if possible, if not, so there's a chance you won't be able to get it paid off by retirement, which is fine. If that's kind of the plan, have a loan that you can do what's called a re-amortization on it. And not all loans allow this. So if you actually go down this path, remember this little part of the conversation. What it would enable you to do is at retirement time is, let's say you have 21 years left on the loan, it'll allow you to reset your payments so that the home would be paid off over 21 years. So in other words, let's say you had a $300,000 loan, just throwing a number out there, $300,000 loan, and you say, I'm going to try to accelerate my payments for the next 12 years as I'm working, and you're making those extra payments, and you get down, now it's 12 years out, now the loan balance is $100,000, let's say. Well, if we can then re-amortize that $100,000 over the remaining term of the loan, that brings your payment way down.
significantly. So I think that you should either start looking for a home right now, or start saving for a home right now. And if you were saving for a home right now,
Well, if he's got a free place to live and it's not mine, then I would say just save for a home.
fair enough. And I would use an online bank like just go to what's the name of that website?
Bankrate.com.
Bankrate.com.
Are you contributing to your 401k now?
A little bit, yeah. I'm trying to. I don't think it's worth it.
Why?
Why?
Right now? Well, because then I don't have as much money to put towards the down payment.
Okay.
Fair enough.
All right, yeah,
Fair enough. Fair enough.
I'm all right with that.
Yeah, so just go to bankrate.com and choose one of the online banks and high yield money market accounts and just put money.
I think it's your biggest thing. We both agree on that. Your biggest thing for financial security for your retirement
is
age.
to own a home. And remember, you consume the home in some form or fashion. So the bigger the home, the more you're going to consume, the more it will affect your retirement. So maybe something modest.
Okay.
All righty?
Okay.
All right.
All right. Hey, we're going to take a quick break. Stick around for more Allworth's Money Matters.
Can't get enough of Allworth's Money Matters? Visit allworthfinancial.com/radio to listen to the Money Matters podcast.
Welcome back to Allworth's Money Matters. Scott Hansen.
Pat McClain.
Thanks for sticking around for our second half hour of the program. And by the way, if you haven't been on I don't mean to seem a pitch for us, but our website's got some great tools to help with retirement. We've got an online learning library for a variety of different courses.
So when you said you don't want to pitch that, we put a lot of time and energy into our website. You could come there and not become a client of ours and still use the tools.
Fair enough. Thank you.
Right? We hope you become a client of ours. We do run an investment advisory business, but if you want to call into the radio show or come to our workshops or avail yourself to any of our learning library
or an
knowledge
online workshop
or whatever, do so. And then if you decide you like us, then maybe hire us.
And if not, fine too.
That's okay.
Good point. Yes. Come on. I'm proud of this thing.
Yeah.
Huh?
We should do a little bit more self-promotion, darn it.
You think so?
Yes.
We're the best.
No, not that much. But go to our website.
Allworthfinancial.com. And
look at the learning library.
There is some good stuff there.
Online workshops on a pretty regular basis.
And we write a lot of articles and videos and webinars and
then in
Zoom
return,
meetings
if you're listening to a podcast, in return, we're going to ask for a little favor. If you want to review us, please
review us.
Review us, our
It helps,
podcast,
the more
or share it
reviews.
with your friends. The more reviews we get, the higher we're ranked. The higher we're ranked.
I don't know if it quite works that way. We got to remember when someone sent it. I don't know how it all works. It's a mystery to me.
Well,
A review's going to be helpful. And frankly, if this is helpful to you, you know what? Oftentimes we have a lot of clients referred to us because we've been doing this radio program 25 years. People have been fans of the program. They see us, but sometimes they don't need an advisor. They're on top of it. They enjoy it. They are competent. They don't need an advisor, but they've got someone close to them in their family that's asking them for advice, wants their help. We get those kind of people referred to us often. So if you're thinking someone in your life, like, send them this podcast, forward this on to them, give them a link to our website, and introduce them so that they can get advice from us, and so they're not bugging you all the time. They can get a second opinion from you, and you're not the one responsible for their lives.
I said we should do some promotion. We shouldn't make it the whole show. Let's go to the calls.
833-99-WORTH is the number. Good
I
point,
think it's
man.
a point.
833-99-WORTH. Let's start off with Dan in Colorado. Dan, you're with Allworth's Money Matters.
Thanks for taking my call, guys.
Thank
Sure.
you.
What can we do for you?
I had a couple of questions about alternative compensation. Our company, like a lot of companies right now, is struggling in the current economic environment. We're implementing a number of different cost reduction measures, and reduced compensation is one of them. And as a partially offsetting mechanism, we're being offered shares in the company, and I'm trying to understand what the tax implications
I
of
haven't
that
seen this
are.
yet.
How big's the company?
The entire group is about a $2 billion group. The division I'm in is about a $200 million
Okay.
division. And so we're being offered some shares, and I have a two-part question. One is how the valuation of the shares will be done. There was a grant date as of last month, and then the shares are vested and become unrestricted at year end. And the company will actually, as part of the payroll function, they'll take some of the shares to cover federal, state, local taxes. And then the remaining shares, I become unrestricted, and I guess I take possession of them, so to speak, at year end. So it's not clear to me.
Publicly traded or not?
Yes.
It is publicly traded. Wow. I haven't seen this. We
No,
have
I
not
haven't
seen
either.
this yet.
No.
This is interesting. And how much is a percentage of your income will be offset with these shares?
So for this year, it would be roughly 10 to 15%.
Have they provided any guidance thus far on the taxation of this?
Reading through the agreement, it's not clear to me how the shares will be valued. In other words, as of grant date.
There was holding state and local taxes, and they become unvested at the end of the year, at which time it would become
Vested, unrestricted, yeah.
Yeah, unrestricted. It would.
That's such a short holding.
Yeah,
I've never
it's
seen
really
that.
interesting. This is a
Right.
cash preservation. How's
Yeah.
the stock of the company doing?
Right now, we're trading. So we took a big hit in March, and we're trading
As a
based
percentage,
on 12 months.
yeah,
About 40% of the 12-month high.
got
That's
it,
not
got it.
too bad. It could be worse, right?
Yeah. So this is a cash preservation method for the company to do that, which is they've turned to an alternative form of currency
Their
other
stock.
than cash, which is their stock.
And so you're when you receive shares, that is a form of compensation, which is taxable. But when they're restricted shares, it's not the same as fair market value because you don't have the option to go out and sell them. You don't have that available to you. So
Well, they become unrestricted as of year end.
Yeah, so
Yeah, I understand that.
but before year end, so it doesn't matter. It all falls into the same calendar year for tax purposes. So the assumption would be, the assumption would be that it would be a taxable event for this year because they become unrestricted.
Yeah. It'll be taxable this year. I don't know at what level.
What does that mean, Scott?
At a minority discounted restricted share value. Because it's not. They're not. They're not traded. He can't.
No,
trade them.
it's a traded stock.
He can't. Not when they're restricted. So
But the restriction comes off by the end of the year. Oh, so your question is what's the value the day they give it to you versus the day they become unrestricted?
And is there a different tax? Does it trigger a different tax situation at 12/31?
Versus
and is there
today?
something in the CARES Act buried in there that provided a twist here?
Wow, you're going to walk away with no answers
Yep.
here.
I've not seen this. I've never seen it.
Yeah, never seen it. It's interesting. It is a brilliant. And what are you going to do anyway? Are you going to leave the company?
He's trying to figure out his tax
No, and
implications.
Yeah.
I want to keep my job, and I kind of tip my hat to him for coming up with
It's actually brilliant.
Well, I think my guess is that my guess the way that's structured is to minimize the tax consequences for the employees. That's why they're giving you restricted shares, and they're having the restriction fall off in such a short period of time as a way to lower your taxable income on those.
So you should
shares.
bet.
That is my guess.
You should bet for planning purposes that it's taxable as ordinary income, which would be the worst case scenario.
But it's probably at a discounted rate.
It probably is. But if I was planning for taxes, I would plan it.
And you'll get more guidance as the year goes on. Everyone's making this crap
since
up.
it's
That's the thing. I mean, it's like we were in a meeting before. I said, you realize we're all making it. The whole world's making this up as you go through it. I mean, no one's lived in a situation like this. So the executive team, and they're doing the best they can, and they get some tax attorneys and whatnot, and what's the latest thing?
Guidance?
Can we try this here and try that? And it sounds like a pretty creative method they're doing.
I like it.
Yeah. I
Hats
think
off
so
to
too.
them.
They could just cut your pay.
Well, They have.
How?
But,
But
Aren't
they're trying to make it up
They're
with
making
stock.
it up in stock.
well, some of it.
Okay.
Okay.
Yeah.
Some of it. Got it.
So, I appreciate that they're taking creative measures to keep us on the payroll and keep us, engaged and active. Just one last part of this. Since the company's withholding from the shares what will cover federal, state, local taxes, what remains in my hands, the number of shares, and maybe you don't know the answer to this, but going forward, would I be holding those shares just as if I acquired them
Yes.
in a regular market acquisition? Okay.
Yes.
Correct. If
Yes.
you-
As soon as the restrictions drop off.
Yes.
Okay.
So my guess is they've got
Well,
my guess is they put the restrictions in place to lower the taxable amount to you and to their employees, and they've had it the shortest period as possible for it to revert back to unrestricted shares, like a share that I could go buy in the open market.
Which brings liquidity to you
And then long term, you'd have capital gain taxes on it.
Right.
after 12
Okay.
months.
All right, hope that helps.
After 12 months of holding the shares myself?
Then it'd be a long term.
Was it 12 months after the restriction comes off, or from the date they're issued?
I would double check that before.
I don't know
pull the
that
trigger
either.
on that. Yeah, but-
There we go.
No,
I'm prepared to hold
I've never seen restriction
Never-
shocks
anyway,
less than a year.
brand new to us. We've been doing this show for 25 years. Never
That's right.
never seen such a thing.
I imagine the company will provide more guidance as time goes on.
Yes.
I think so too, but just popped into my head here.
Yeah,
And
yeah, that's a good
I got-
question.
listen-
That's a good question.
I got to give it to him. This is
I do too.
creative.
Yeah.
I like where they're going with it. It's creative, and if there's one way to get everyone motivated about the stock price, this would be it.
Yeah. Guess what? We're on this together. So, yeah. Well, good luck to you and at the company there, Dan, and hope it all goes
Yeah, thanks for calling the
well
show.
for you. It's a challenging time for lots.
Interesting.
We're going to move to Gary in Northern California. Gary, you're with Allworth's Money Matters.
Hey, guys. Thanks for taking my call.
Thank you for joining us.
Yeah, so I've been impacted by job actions at work. I'm 52, have a 401k, so I understand I can pull my money out and move it into an IRA. And so I've been managing my own money for the last 30 years, doing the proper adjustments between large cap, small cap, et cetera. I'm 100% equities, following your show and guidelines and whatnot. But I'm approaching that point in my life where, well, not only did the job riskiness kind of jump up in the last couple of weeks, but I'm wondering if at 52, is it time now to look at moving the risk bar down a bit? But larger than that, is it too soon to engage a firm like yourself that will offer me some management aspects that I just don't have the skill set to do? Investing in REITs and bonds and all this type of stuff that gets me out of the 401k and into an IRA with a lot more options.
So the first question is, yes, you should probably take a look at your allocations, and you may be fine at 100% equities, but you may want to bring it down a little.
Yeah, tell us about this is not uncommon. You're 52. Let's go back a month ago before things started happening at work. When were you planning on retiring?
I'm shooting for 62 to 65, so I got about 10 years-ish left.
And are you at a point now that you're concerned that maybe your job's not going to be around a year from now and you might have to go find something different and you don't know what that's like because you haven't been in the job market for a long time? Or
Well, I'm in the midst of that right now. The exit date is approaching, so I'm in the job hunt market.
Yeah, and what's the outlook for you?
Well, I hope it's good. It's only been 6 weeks in. My wife says I need to be more patient and whatnot, which God didn't bless me with.
Okay, well, good for you.
I tell you, so I'm not telling you this to scare you. I'm just giving. I have a good friend of mine. He mid-50s. He's got a master's degree from Pepperdine. Was with the same company 21 years. One day they did a reorg. He's out, right? It took him 11 months to get a job.
To get the job he wanted.
Yeah, and that may be the case. I've been in this place 28 years, so it's a similar footprint.
So you've been there for 28 years.
Yeah.
Well, to get a career job to continue forward, yes.
Without relocating is oftentimes the difficult part, depending upon how far up you are in the pyramid of the company.
Yeah, and I think what happens, Gary, and what you probably experience as you get further in your career, you become really great at a couple things, right? And a specialist in a few different areas, and sometimes and you've got a certain income level that you need to replace. But the only reason I'm saying this is because you said your wife said give it some time, and these things can take time, and don't lose hope. And I think it's particularly hard as we get a little older in life. We've had some of the major milestones that life happens, and then it's like, are we still needed here in the marketplace? Are we still of value? Right, and all those emotions start kind of going through our head, and then we start second questioning, and maybe I need to start taking money from my retirement account now at 52. So maybe I'm overly aggressive, and it all kind of happens at the same time.
But
exactly. And I'm wondering, do I just continue on with my investment mindset?
So tell us about your situation.
Is now the right time?
Do you have any kids that you're still supporting?
A boy in high school, and I have another son that's in college, and he's paying his own way. So I just got a youngster that'll be going to college in a couple of years.
And does your wife have a job outside the home?
Yes, she does.
And what do you owe on your house?
About $250.
What's the value of the home?
Probably a little over $5.
Do you have much in the way of other debts?
No.
And what?
No debt at all.
Good for you. What do you have as in your 401k, IRAs?
I'm sitting on mine about just shy of 1.2. My wife's got about 250, and we have some cash holdings and stock and savings.
You guys are great savers.
How much do you have in cash and stock?
About 120 in cash and about 100 in stock.
So the answer to the question is
and what's your annual income?
Approximately.
Personally, just you.
Just me, about 150.
Okay.
So you guys are great savers. Great savers. I don't know if you need me to tell you that, but you've done a good job. The allocation may or may not be too risky.
What were you going into the financial crisis? I know you're younger then, but
yeah, I was younger. We rode it through. I rode that thing through, and it has been a great run. But getting closer to that 62 age, there become some realities where you have to be strategic in your thoughts and not as bold as you were when you were 35.
So the question we're having, I can't speak for Scott, but the question I'm asking myself, is this a reaction to what happened in your job life, which isn't unusual?
And frankly, there are times when there's events in life that causes us to have a kind of a different risk profile than what at other times we're saying, I have so many uncertainties in my life now that I want a little more certainty with my investments.
I think lowering and if you came into our office, we would actually bring you through a risk analysis, a program that would help us understand what that is today, right? It may not be the same. Your risk could be different 2 years from now as it was 2 years ago.
But even if you're looking, so let's say you plan on full retirement 10 years out, you're not going to spend your entire 401k at 62. You're just going to take some income on it.
But Scott, he's such a great saver, and he's going to continue to save for another 10 years. To move this portfolio to 80 or 85 or 90% stocks is not a big deal, down from 100% in equities. So the answer to the question is,
I would agree.
If you trim some of the equity exposure off by 10 or 15%, I don't think that you would be hurting yourself over the long term.
And
do you think there's any value in funds that I don't readily have access to, like REITs and all that I would move this into?
Oh, absolutely.
A realm where you manage for me and give me a far more broad diversification of.
Absolutely. One of the reasons that people actually use IRAs versus the 401k is because of that. If you were over age 55, our answer might be a little bit different. Between the ages of 55 and 59 and a half, maybe a little bit different. So if you came in to visit with our firm, or I would say any good financial planning firm,
independent fiduciary firm,
they're going to, the good ones will want to do a financial plan on you. And the questions you would ask is, Can I retire in 10 years? And what will it look like?
That, and I also think, what is your income need right now? Because you've been at 150, and
maybe you could live at 100 and still get to your objective.
We can live on my wife's salary. It'll be tight, but we can.
No. What I'm meaning is, and maybe you'll find the job, the perfect job you just absolutely love, and it pays you $150 a year. Maybe, but when I'm just thinking, what if there's some job that you absolutely love? Like this would be a great job, but it only pays me $110. I've been making $150. I don't want to take that big of a step back. This is where some financial planning might be helpful for you, because we've seen a lot of times, Gary, and you may have loved your job you're in, but we've seen a lot of people, they've kind of in this grind. They're like, I'm going to retire in 7 years, counting down the years. Like, why? Well, I don't like what I'm doing, or what? And through some planning and whatnot, they went and found other careers, sometimes not at the same pay level, but it's so much, they enjoy it so much more. They're saying, I'm fine working another year or two. What I'm questioning is, you might already have enough in retirement savings now that if you project out another 10 years from now without much in additional savings, you might still be fine.
What's your retirement look like? So that's what you're going to get out of a good financial advisor, as well as the asset management of how those dollars are being allocated and how quickly they're being watched, or closely they're being watched. So
I have one question on the fee structure.
Mm-hmm.
The fees that you charge, whether it's 0.9 or 1.1% or whatever, is that inclusive of the fees that are charged normally when you look at the fee costs within a particular fund?
No.
Or is that on top of?
It's on top of.
Okay.
So, but the fees,
a good advisor is going to use very low cost funds.
Yeah, the fees are going to be pretty low cost.
Basis points.
And if you look at pricing, in terms of pricing, I can only speak for ourselves. We're about middle of the road in terms of pricing. We're not either on the high side, we're not on the low side, but
But talk to a couple of advisors. I think it would be
spend the time,
particularly now that you've got some once your job's over and you've got some time.
Yeah, there's no hurry to roll that 401k into an IRA either. So
okay,
none at all.
Very good.
All right, appreciate the call.
And let's talk to Evaristo in Northern California. You're with Allworth's Money Matters.
Good morning.
Good morning. How are you today, sir? How can we help you?
Fine, thank you. I had a question with several other sub-questions dealing with spousal benefits from Social Security.
All righty. Fire away.
I retired last year from teaching, and I am 66. So that means I have a pension and a very small, if any, Social Security coming to me. My wife has her full amount of Social Security that she'll be claiming next year. Next year she'll be 70.
All right.
And so let me give you my three questions, because this is sort of what we've been operating on, but we need a reality check from somebody that knows the stuff. And so one question is, am I eligible to claim spousal benefits off of her account? And secondly, we're assuming that I am eligible. So I understand we get like 50%. I would get 50% of her total.
You get the maximum. Yes, you get the maximum of either your benefit or 50% of a spouse's benefit.
Hers is way higher.
Yeah.
Yes.
So the second question is, will that windfall elimination provision reduce that 50% more? Third question has to do with timing. Like when do I have a deadline to claim spousal benefits? So those are the three questions in a nutshell.
Yeah, and I wish I'd say that we were both experts at spousal benefits for windfall elimination provisions within Social Security, but
I don't know.
I don't know either.
I don't know. I don't.
And one of the things we'd like to have our program where our calls aren't screened ahead of time. So when we answer questions, it's you're testing Scott and Pat's.
But we could get to the answer.
Yeah, I just don't know it off the top of my head.
Yeah, I don't know it off the top of my head. It's pretty. The percentage of the population this applies to is relatively small. But there is.
I don't recall. I know I've learned it before. I just don't remember the top of my head. I've actually narrated. We have on our website, and I don't. Have you listened to our Social Security website? I mean, our Social Security presentation on our website, Evaristo?
No.
Okay, so we've got a lot of great education tools on there, but one is on Social Security. We go into a lot of the different nuances, and it covers, I don't know, probably 95% of the questions that people would have on Social Security. I believe I was the one who narrated the thing, and I just don't recall. So,
but we'll get you an answer. We will get you an answer on this.
Okay.
Yeah. So just stay on hold. We'll get you information, and one of our advisors will follow up. And
we'll get you an answer. And we're not calling you to try to sell you on how to use our firm. We just truly, I don't remember. Yeah. And the windfall elimination provision, it has to do with certain pension plans for government employees where they did not pay into Social Security. My recollection is that he's eligible for 50% of her benefit, regardless of the windfall elimination provision. But
yes, mine too.
That's my recollection.
Yeah.
But
it's interesting,
I'm not confident enough to actually state that on the air.
It's interesting and there might have been an opportunity with the file and suspend or restricted claim that
went away.
Yes, that might have been better planning a few years ago. There are a lot more questions on Social Security today than there were 5 years ago, 10 years ago, 20 years ago.
It's a lot more complicated than it was.
Is it?
I think so.
What's more complicated about it?
Well, the windfall elimination provision.
That's been there ever since I was in the industry.
The changes, the file and suspend. Maybe it's just us. Is it more complicated? Maybe you're right. It's not more complicated.
I don't know. I think people are realizing that
it's a lump. It's a lot of money.
I mean, I know that our firm and other firms like ours, I would assume, we use software programs to help us figure out how to maximize Social Security. So that's part of our planning. But it used to not be that there would be so many questions from people.
Yes.
Because we get people writing questions. We have again at allworthfinancial.com. If you're on its, I don't know if it's our learning library or what we call it. We've got something on our website where we've got a lot of education tools, and we've got something on Social Security. If you've got questions before you might want to take a few moments to go through that. I think would be helpful. But we also have workshops where
Social Security is the most well attended.
Yeah, it's interesting. I don't know. It's just
Evaristo, thanks for the call, and we will get you the information.
Well, that is all the time we have this week. Again, you can get a podcast of this program wherever you listen to podcasts or at allworthfinancial.com, and we will be back on the same station at this same time next week. This has been Scott Hanson and Pat McLean, Allworth's Money Matters.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.